from Li Lu's investment in Lukoil, a deep dive into a value play. Part 4, The Voucher Machine, How Ownership Was Given Away. Here's where the mispricing becomes mechanical, because once you understand the voucher system, you realize this wasn't just panic. It was a machine designed to misprice assets. The Russian government doesn't privatize carefully. They don't sell companies to the highest bidder. They distribute ownership to everyone equally, indiscriminately, and fast. Every citizen gets a voucher, one piece of paper, supposedly worth the same for everyone, supposedly representing a slice of the country's productive assets. In theory, this is democratic capitalism. In reality, it's chaos. Most people have never owned equity. They don't know what a share is. They don't know what an oil company is worth. They don't know what to do with a claim on future cash flows when the present is collapsing. So the voucher isn't seen as an asset, it's seen as a nuisance. Something abstract, something uncertain, something that can't be eaten or burned or exchanged for rent. And because the vouchers are bearer instruments, whoever holds them owns them. They immediately become tradable on the street. No screens, no brokers, no liquidity pools, just people with paper and people with cash. The supply is enormous. Tens of millions of vouchers flood the market at the same time. The demand? Almost non-existent. Not because the assets are bad, but because the buyers who could value them don't exist locally yet. There's no investing culture, no institutional capital, no long-term mindset. So the clearing price collapses. Vouchers trade for the equivalent of a few dollars, sometimes less, sometimes for goods instead of money. And this is the crucial point. The price of the voucher has nothing to do with the value of what it can buy. It's set by desperation and confusion, not appraisal. The mechanism that converted this state wealth into tradable equity, and therefore accessible to investors like Li Lu, was the Voucher Privatization Program, VPP, launched in October 1992. Designed by Anatoly Chubais and the State Committee for State Property Management, GKI, the program aimed to transfer ownership of state enterprises to the private sector rapidly. The primary goal was political, to create a class of private property owners so quickly that a return to communism would be impossible. Every Russian citizen, including minors, received a privatization voucher with a nominal face value of 10,000 rubles. These vouchers were bearer instruments, meaning they could be bought, sold, or traded freely on the secondary market. They served as the currency for voucher auctions, where equity stakes in state-owned enterprises, SOEs, were sold to the public. The distribution was massive in scale. Approximately 144 million vouchers were issued to a population of roughly 148 million. The 10,000 ruble face value was purely nominal. In the hyperinflationary environment of late 1992 and 1993, the market value of the voucher fluctuated wildly, trading on street corners and exchanges for anywhere between $4 and $20. The pivotal insight for deep value investors lay in the behavior of the voucher recipients. For the average Russian citizen, struggling to survive food shortages and the collapse of the social safety net, a piece of paper promising future ownership in a factory was abstract and functionally worthless compared to immediate consumption needs. Vouchers were sold en masse on street corners for bottles of vodka, sacks of potatoes, or small amounts of cash. This mass liquidation by the populace created a supply glut that depressed the price of the vouchers well below the intrinsic value of the assets they could purchase. Consolidators, often operating in gray markets, purchased these vouchers for as little as $4 to $12, bundling them to bid for large blocks of shares in voucher auctions. Because the supply of vouchers was fixed and the number of enterprises to be privatized was vast, over 15,000 medium and large enterprises, the implied valuation of the entire Russian industrial base was absurdly low. As the data in Table 1 illustrates, the market capitalization of the entire privatized Russian economy, including giants like Gazprom, Lukoil, and Norilsk Nickel, was valued by the voucher market at roughly $3 billion to $12 billion. This figure was smaller than the market capitalization of a single mid-sized American utility company or a single Western oil major like Texaco. This disconnect was the foundational thesis for Li Lu. You didn't need to be rich or connected to get a voucher. Every Russian citizen was issued one by the state as a physical paper certificate during privatization, usually distributed through workplaces or local offices. Once you had it, it was literally a bearer instrument. You could sell it for cash on the street, hand it to a middleman, or take it yourself to a voucher auction or investment fund. Physically, that meant showing up with the paper voucher, submitting it to an auction or fund in exchange for shares, often via crude paperwork and registries, and receiving a claim on equity in a real company like Lukoil. Most people didn't understand or trust that process, needed cash immediately, and dumped the voucher. The few who did understand simply aggregated thousands of these pieces of paper and converted them into ownership of industrial assets at prices that made no economic sense. So, each voucher can be exchanged for shares in companies like Lukoil, real companies, producing companies, global commodity companies. But the market doesn't price that. It prices the voucher. And when vouchers are dumped en masse by people who don't want them, the implied valuation of the entire Russian industrial base implodes. This is how you end up with one of the largest oil producers on Earth being valued at less than a mid-sized American utility. Not because anyone ran the numbers and decided that was fair, but because the ownership distribution mechanism severed price from value. The system created a one-time, non-repeatable imbalance. Millions of forced sellers, no informed buyers, physical friction-heavy trading, zero institutional support, extreme time pressure on the sellers. That combination is lethal to price integrity. And Li Lu understands something subtle here. This isn't a bad market. It's a non-market. Prices aren't signals. They're symptoms. Symptoms of fear, of urgency, of cognitive overload. So when he looks at voucher prices, he doesn't treat them as information about value. He treats them as evidence of dysfunction. And dysfunction, when it's this large and this structural, is exactly where deep value lives. The voucher machine didn't just give ownership away. It guaranteed that ownership would land in the hands of people who didn't want it and then be sold to the few who understood what it really represented. That's not luck. That's design colliding with human behavior. And when those two collide at scale, the result is what Li Lu was waiting for. Assets priced not by what they are worth, but by how badly someone wants to get rid of them. This is Avi. Like and subscribe. On to the next.